A single headline just moved TSMC 2.5% in one day. But most retail investors are reading it completely wrong. Look, if you're short on time or you don't feel like listening to some random cat on the internet, here's what you need to know. The reported US-Taiwan deal isn't about tariffs. It's about who controls the future of compute. If you remember nothing else from this video, remember that the 15% tariff number everyone's fixating on is a distraction. The real story is the 5 additional semiconductor facilities in Arizona, and what that means for TSMC's geopolitical risk premium. That's it. That's the thesis. Now, if you want the full breakdown, stick around for the next 10 minutes. We will cover it from both the fundamental and technical angle. So, quick intro for anyone new here. I'm DataCat, former corporate analyst. Spent years inside a Fortune 50 company, staring at messy data, building models, pipelines, and slowly losing my soul after 4 cups of coffee. Eventually, I traded the fluorescent lights for, well, lasers and keyboards. Started this channel about 5, almost 6 months ago now. Still pretty small, still figuring things out, honestly. I'm not here to sell you a course. I'm not here to tell you I've cracked some secret code. I'm just a guy, an introvert really, who spent way too long looking at meaningless data and thought, maybe I can explain some of this stuff in a way that actually makes sense. No hype, no shouting, just the data and what it might mean. Alright, enough with that. So just now, the New York Times drops a report saying the US is, quote, nearing a trade deal with Taiwan. The key details are tariffs on Taiwanese goods would drop to 15%, and in exchange, TSMC commits to building at least 5 additional semiconductor facilities in Arizona. Now, the Times described this as being in a, quote, legal scrubbing phase. So, this is not a done deal, it's reported, it's pending. The impact I'm about to walk through is conditional on final terms and execution. Keep that in your back pocket. The market predictably reacted. TSM was up 2.5% on the day, basically kissing its 52-week high. Volume was about 1.13 times the 20-day average. Solid but not a blow-off top kind of spike. The candle itself? Big green body, small wicks. Buyers controlled that session. But here's what I want you to understand. That price move wasn't really about 15% tariffs. Allow me to explain. So, 15% tariffs on Taiwanese goods. Sounds significant, right? And for the broader macro picture, sure, it matters. Lower landed costs for US importers, better planning certainty for supply chains tied to Taiwan. That's real. But for TSMC specifically, the direct tariff sensitivity is way less straightforward than headlines make it seem. Why? Because semiconductor value chains cross borders multiple times. You've got wafer fabrication in one place, packaging and testing somewhere else, then assembly into finished devices in yet another location. By the time a chip reaches its final form, it's touched maybe 3 or 4 countries already. So 15% times TSMC revenue is not how the math works. The bigger effect here is political and strategic, not a direct earnings lever. Wall Street analysts know this. Most retail investors don't. And that gap in understanding, that's where mistakes get made. Okay, so if tariffs aren't the main event, what is? 5 additional semiconductor facilities in Arizona. At least 5 according to the Times. That's the meat of this deal. And the impacts here split into 2 completely different timelines. You've got to think about near term versus medium to long term because they point in opposite directions. In the near term, more facilities means more capital expenditure, US construction costs are higher, US labor costs are higher. Yield ramps, getting those fabs to produce chips at competitive efficiency, take time and money. TSMC's been pretty open about the fact that their Arizona operations have faced challenges. Staffing, regulatory complexity, the learning curve, all of that is real. So, in the short run, this commit could be a cash flow headwind, it could pressure margins. If you're just staring at the next 2 or 3 quarters, this is not that obviously bullish. But, and here's what the market is actually pricing. There's a de-risking premium in play. TSMC has historically traded at a discount because of one thing, Taiwan's geopolitical situation, the concentration risk, the what-if scenarios that keep defense analysts up at night. And think about it. Given the recent events, what if the what-if scenario is becoming the new reality? Now, I'd be doing you a disservice if I pretended we have full clarity here. We don't. The New York Times report leaves several critical questions unanswered. First, are these 5 facilities truly additional to previously announced plans, or is this a relabeling of commitments TSMC already made? That distinction matters a lot for incremental capex. Second, what process nodes are we talking about? leading-edge 3 nanometer, mature nodes. The economic profile of a cutting-edge logic fab versus a specialty fab is completely different. Third, what's the incentive structure? Are there CHIPS Act subsidies involved? Tax treatments? Milestone-based payouts? That affects the actual cost to TSMC. Fourth, are there strings attached? Technology transfer limits, domestic sourcing requirements, export control implications? Any of these could change the calculus. Until we get official announcement text and TSMC management commentary, we're working with incomplete information. And in investing, incomplete information means position sizing matters. We don't bet the house on a headline. Alright, let's talk about the technicals, because the fundamental story doesn't exist in a vacuum. Price action tells you what other investors are actually doing with their money. As of Monday, TSM is in a confirmed uptrend. The Golden Cross has been active for 138 days. Both averages are sloping upward. Price is sitting 7% above the 20-day EMA and 12% above the 50-day SMA. So the trend is clearly bullish. No ambiguity there. But, and this is the but that matters, the stock is extended. You're sitting right under the 52-week range. The RSI is sitting around 69, right at the edge of overbought territory. Stochastics are at 82 over 79. MFI is at 75. All of these indicators are saying the same thing. Momentum is strong, but positioning is crowded. And late-stage chase behavior often looks exactly like this. The key level to watch is $333.55. That's the 52-week high. If TSM closes convincingly above that with solid volume, you've got a breakout attempt. Next round number magnet would be 340. Consider the ATR is about $8. If it fails there and drifts back toward 320, there's a Fibonacci level around 319. That's actually a healthier setup for adding. Pulling back to reset momentum while staying above key moving averages is usually a better risk-reward entry than chasing new highs. And a quick note, one more angle worth considering. What does expanded TSMC US presence mean for the competitive landscape? Intel and Samsung are both trying to build out domestic foundry capabilities. A larger TSMC footprint intensifies competition for skilled labor in the US semiconductor space. It competes for construction resources. It competes for government incentives and political mindshare. Who's actually delivering on the promise of domestic chip production? For equipment and materials suppliers, companies like ASML, Applied Materials, Lam Research. More fabs generally means more demand for tools. But the exact beneficiaries depend on timing and tool mix. If these Arizona facilities are leading-edge logic, that's a different equipment profile than mature node specialty production. So if you're thinking about second-order effects, the supplier ecosystem is worth watching. But that's probably a topic for another video. And if you're already long TSM, this news probably doesn't change your thesis. If you're looking to add, chasing at 52-week highs with overbought momentum indicators is statistically not the highest probability play. Waiting for either a breakout confirmation or a healthy pullback to the 320 zone is probably smarter. But if you're short, good luck. Fighting a structural uptrend backed by AI compute demand and now reduced geopolitical discount is a tough game. Alright, that's the breakdown. No hype, no nonsense, just the data and what it might mean. If this was useful, consider hitting the like button. It helps the algorithm figure out that maybe, just maybe, financial content doesn't have to be clickbait garbage. And if you want more of this kind of analysis, actual reasoning, not just headlines, subscribe. I'm still small, still growing, still figuring out this whole YouTube thing, but I'll keep showing up with the best analysis I can put together. Remember, in investing, as in life, curiosity didn't kill the cat, overconfidence did. Thanks for watching. DataCat out, and I'll see you in the next one.